Listen carefully because the issue is not the headline. The issue is the machine behind the headline. When people hear that America has a debt problem, most of them respond in one of two useless ways. They either panic and imagine the whole system collapses tomorrow, or they shrug because they have heard the same warning for so many years that the number no longer feels real. Both reactions are wrong. The debt is not a reason to panic tomorrow. It is also not something you can ignore. It is a force that changes incentives, policy, asset prices, inflation, interest rates, and the value of your savings over time. That is how large debt problems usually work. They do not always explode. More often they are managed, hidden, stretched, refinanced, inflated away, and transferred quietly from one group to another. The people who do not understand the transfer lose purchasing power and call it bad luck. The people who do understand it position themselves differently and call it preparation. Right now, the United States is carrying a debt load that has become so large that the normal political answers no longer work cleanly. The number is roughly $39 trillion in the argument being made here, and even if your eyes glaze over when you hear a number that large, you should force yourself to feel what it means. A trillion is not just a big billion, it is a different category of scale. If you spent $1 every second continuously without sleeping, without stopping, from the beginning of the modern calendar until today, you still would not have spent $1 trillion. Now multiply that kind of number many times. That is the scale of the obligation sitting on top of the American economy. But the principle is not even the most important part anymore. The interest is the cost of carrying the past. When a government borrows, it pulls spending forward. It spends now and promises that the future will carry the burden. When the debt is small and growth is strong, that can be manageable. When the debt becomes enormous and interest rates rise, the carrying cost becomes a major part of the budget. That is where the system becomes constrained. The United States is paying around $1 trillion a year in interest in the framework of this argument. Not to reduce the debt, not to build new roads, not to modernize the grid, not to improve education, not to make the military stronger, just interest. Rent on past spending. That interest cost competes with everything else. Social Security, Medicare, defense, infrastructure, education, the ordinary functions of government. And unlike many budget items, interest does not require a new political debate every year to grow. It grows because the debt exists and because the interest rate structure changed. That is why the debt problem is not only a fiscal problem, it is a monetary problem. The Federal Reserve becomes central because the Fed influences the cost of money. Interest rates determine what households pay, what businesses pay, what banks earn, what savers receive, what borrowers owe, and what the government must pay to roll over its debt. When the debt is extremely large, interest rate policy becomes more than a tool for managing inflation. It becomes a tool for managing national solvency pressure. That is the part most people do not understand. They think the Federal Reserve is simply deciding whether mortgages should be cheaper, whether stocks should rise, or whether inflation should cool. But when sovereign debt becomes very large, monetary policy becomes part of the debt management system, whether central bankers admit that clearly or not. Now, there's a lot of noise around a new Federal Reserve chair, possible policy shifts, and viral claims about secret plans to cancel the national debt. The specific personalities and calendar dates are less important than the underlying structure. Do not get trapped by the drama. The real question is not whether one person has a secret plan. The real question is whether the system has a mathematical incentive to reduce the real value of debt over time. And the answer is yes. That is where the concept of financial repression becomes important. Financial repression sounds like academic language, but the idea is simple. The government and central bank create conditions where interest rates are kept below the rate of inflation, either directly or indirectly. Savers earn less than the rate at which money is losing purchasing power. Borrowers benefit because the real burden of their debt shrinks. The government, being the largest borrower, benefits most of all. If inflation is 5% and the government can borrow at 3%, then in real terms the lender is losing purchasing power, and the borrower is gaining relief. The number on the bond may still say the same thing. The purchasing power behind that number is smaller. That is how debt can be reduced without being openly defaulted on. There is no announcement that says we are taking your savings. There is no single vote that says bondholders will be punished. There is no dramatic moment where people realize the system has changed. The transfer happens through real rates. It happens through the gap between what your money earns and what inflation takes. That is why financial repression is so powerful politically. A default is obvious. Austerity is painful. Tax increases create anger. Inflation and negative real rates are harder for people to see. They feel it at the grocery store, in insurance premiums, in rent, in medical costs, in tuition, in housing, in everything they buy. But they do not always connect that loss of purchasing power to the government's debt management problem. That disconnection is what makes the policy possible. Most people measure their wealth in dollars. They should measure it in purchasing power. That is the first great shift in thinking. A savings account balance can stay the same while real wealth declines. A bond can pay interest while the real value of those payments falls. A salary can rise while lifestyle affordability gets worse. A retirement account can look larger in nominal terms while the cost of retirement rises even faster. The machine works on the difference between nominal and real. If you do not understand that difference, you can be losing while thinking you are safe. Now, before we go further, let us examine the conventional solutions to a debt problem. The first solution people suggest is higher taxes. Raise taxes on the wealthy, raise taxes on corporations, raise taxes on capital gains, raise taxes on everyone. Taxes can help at the margin. But at the scale of a $39 trillion debt problem, taxes alone do not solve it politically or mathematically. Even confiscating large amounts from billionaires would not permanently fix the long-term trajectory if annual deficits, entitlement obligations, and interest costs continue to compound. The second solution is spending cuts. In theory, this is simple. Spend less, balance the budget, reduce deficits. In practice, the largest categories of federal spending are politically and structurally hard to cut. Social Security, Medicare, defense, and interest payments dominate the budget. Interest cannot simply be cut without default. Entitlements are politically sensitive because tens of millions of people depend on them. Defense is treated as a strategic necessity. Cutting small programs may make speeches sound responsible, but it does not fix the core math. To truly solve the debt through cuts alone would require pain on a scale the political system is not built to deliver. The third solution is growth. Grow the economy fast enough that debt becomes smaller relative to GDP. This is the best solution when it works. Real productivity growth can solve many problems. If the economy becomes more productive, incomes rise, tax revenues rise, and the debt burden becomes easier to carry. But growth has to exceed the debt growth and interest cost. When debt is compounding quickly and the economy is not growing fast enough, growth alone becomes insufficient. You would need an extraordinary productivity boom. And while technologies like AI may help, no serious person should treat that as guaranteed. AI can be deflationary in some areas because it can reduce labor costs and improve productivity. But AI can also be inflationary in other areas because it requires enormous energy, data centers, chips, infrastructure, and capital spending. If it disrupts labor markets enough to provoke political responses, that can also create fiscal pressure. So AI may help. It may not solve the debt problem cleanly. Anyone who tells you it will certainly solve it is guessing. That leaves the fourth path: reduce the real value of the debt. That is financial repression. It is not new. After World War II, the United States had a very high debt to GDP ratio. The country did not simply pay down that debt in the way a household pays down a mortgage. Instead, a combination of growth, inflation, interest, rate controls, and financial repression reduced the debt burden over time. The nominal numbers mattered less than the real purchasing power. The debt was not fully paid in the way people imagined. The dollar became smaller. Inflation did part of the work. Savers and bondholders absorbed part of the cost. Asset owners tended to do better because the prices of real and productive assets adjusted upward over time. That historical precedent matters because governments with large debts usually prefer the least politically explosive path. Open default is too destructive. Massive austerity is too unpopular. Huge tax increases are too limited and politically costly. High growth is desirable but not controllable. Financial repression is quiet. It moves slowly. It feels technical. It is easier to deny while it is happening. That is why it is so likely to be used again in some form, not as a secret plot, as an incentive-driven policy response. When debt is too large, the system prefers to make money worth less rather than explicitly admit that promises cannot be honored in full real terms. This is the key. The government does not need to cancel the debt. It can cancel part of the debt's real value by allowing inflation to run above the return savers receive. That is more subtle and more effective. If you owe someone $100 and inflation cuts the value of the dollar in half over a decade, you still hand them back $100 in nominal terms, but in real purchasing power. You have paid them back with cheaper money. That is not an accounting default. It is an economic transfer. The people holding cash and long-term fixed-rate bonds pay. The people holding productive assets, scarce assets, and assets with pricing power tend to be better positioned. This is why the issue is not only what the Fed does next month. It is how the entire policy environment evolves over the next decade. There will be debates about personalities. There will be arguments about whether a new Fed chair is hawkish or dovish. There will be viral claims about exact rate targets. There will be specific dates thrown around as if they are certain. There will be social media narratives that mix truth with speculation. A serious investor should not be moved by every one of those claims. Separate the facts from the drama. It may be true that a potential Fed chair has criticized the Fed's balance sheet. It may be true that there are public comments about regime change in monetary policy. It may be true that there is historical precedent for financial repression. It may be true that the debt math points toward a repressive monetary environment. But specific rate targets, exact transition dates, and claims that one person can unilaterally dictate the entire Federal Reserve are often overstated. The Federal Reserve has a structure. There are multiple voting members. A chair has influence, but not monarchy. Monetary policy is made through a committee process within political, economic, and market constraints. So do not build your financial life around one viral prediction. Build it around the durable structure. The durable structure is this: the debt is too large. The interest burden is rising. The political system cannot easily cut or tax its way out. Growth may help but is uncertain. The most politically viable path is to reduce the real value of debt over time. That means financial repression or something close to it is likely to be part of the next era. Once you see that, the investment implications become clearer. The first step is to stop measuring wealth in nominal dollars. Your savings account is not your wealth. Your wealth is what your savings account can buy. If your account balance rises 4%, but the real cost of your life rises 7%, you have lost ground. If your bond pays you 5%, but inflation and taxes take more than that, you are not preserving wealth. If your salary rises, but housing, insurance, food, healthcare, and taxes rise faster, you are not becoming richer. Purchasing power is the real scoreboard. This is why cash can be dangerous in a repression environment. Cash feels safe because it does not fluctuate on the screen. A dollar remains a dollar. The balance looks stable. There is no red candle. There is no market crash. But cash loses in a different way. It loses by becoming less useful. That is the inflation tax. It is automatic, silent, and relentless. When you hold too much cash for too long in a negative real rate world, you are volunteering to be the lender who subsidizes the borrower, and the largest borrower is the government. This does not mean you should hold no cash. Cash is necessary for emergencies, liquidity, and optionality. But cash as a permanent wealth strategy is usually a bad answer in a financial repression cycle. The second step is to own assets that can maintain or increase purchasing power. The first category is high-quality equities. Not every stock, not speculative companies with no pricing power, not weak businesses that need cheap money to survive. High-quality companies with durable demand, strong balance sheets, strong margins, and the ability to raise prices when their own costs rise. Pricing power is one of the most important concepts in inflationary environments. If a company's costs rise and it cannot pass those costs to customers, margins compress, earnings fall, the business becomes weaker. If a company can raise prices without losing customers, it can maintain real earnings. That kind of company is better positioned when the currency loses purchasing power. The market may still be volatile. Stocks can fall hard. Valuations matter, entry price matters, diversification matters. But over long periods, ownership of productive businesses is one of the primary ways to protect against currency debasement. A business that sells essential or highly valued goods and services can adjust in nominal terms as the currency changes. Cash cannot. The second category is hard assets. Gold, silver, real estate, and other scarce physical assets can play a role because they cannot be printed into existence the way currency can. Gold has no cash flow, but it has scarcity and monetary history. Silver has industrial and monetary characteristics. Real estate can provide utility, rent, and inflation-linked replacement value, though it also carries debt, tax, maintenance, and local market risks. The principle is not to put everything into one hard asset. The principle is to own some assets that are outside the direct promise structure of paper money. When dollars become less valuable, scarce assets often rise in dollar terms, not because they magically became more useful overnight, but because the measuring stick became smaller. That is a powerful idea. If the currency is being diluted, assets with scarcity and real-world utility become more important. The third category is assets with provable scarcity or unique value. Some people include rare collectibles, high-end art, or other scarce assets in this framework. These can perform well in certain environments because supply is limited and wealthy buyers seek stores of value outside traditional paper assets. But this category is more specialized and less liquid. It requires expertise. It has high transaction costs. It can be difficult to value. It is not appropriate for everyone. The principle is scarcity, but scarcity alone is not enough. There must be demand, authenticity, liquidity at some price, and protection from fraud. The fourth category is diversified real assets and productive exposure. Commodities, infrastructure, energy assets, and certain real asset-linked businesses can benefit from inflationary or repression environments, but they are cyclical. They should be used carefully and sized appropriately. The point is not to chase whatever went up recently. The point is to make sure your portfolio is not built entirely out of nominal claims that can be eroded by inflation. Now we need to talk about what does not work well. The first trap is long-duration bonds. A long-duration bond locks you into fixed payments far into the future. If inflation runs hotter than the market expected when you bought the bond, the real value of those payments is crushed. This is exactly the kind of asset that financial repression can punish. The government benefits from paying back debt in cheaper dollars. The long-term bondholder receives those cheaper dollars. If yields are artificially held below inflation, the bondholder loses purchasing power year after year. This does not mean all bonds are bad. Bonds can have a role. Short duration instruments can provide liquidity and income. High-quality bonds can reduce volatility in certain environments. But long-duration fixed rate bonds are vulnerable when inflation surprises higher and real rates are suppressed. The second trap is excessive cash. Again, cash has a role. You need emergency liquidity, you need optionality, you need dry powder. But holding large amounts of wealth in cash because you feel uncertain can be a mistake if inflation is systematically eroding purchasing power. Feeling uncertain is rational. Responding to uncertainty by accepting a guaranteed real loss is not always rational. The third trap is concentration. People often respond to a big macro thesis by going all in on one asset, all in on tech, all in on gold, all in on crypto, all in on real estate, all in on cash, all in on one country, all in on one story. That is dangerous. A thesis can be broadly right and still damage you if you express it through a concentrated position that suffers from timing, valuation, leverage, regulation, liquidity, or unexpected change. Financial repression may reward certain assets, but the path will not be straight. There will be drawdowns, there will be policy surprises, there will be periods when cash feels smart, there will be periods when stocks fall, there will be periods when gold does nothing, there will be periods when real estate struggles, there will be periods when bonds rally because growth collapses. If you are concentrated, you need to be exactly right not only on direction but also on timing and behavior. That is hard. Diversification across asset classes is not a slogan. It is a survival strategy, not because diversification always maximizes returns, because it reduces the chance that one wrong assumption destroys you. The fourth trap is thinking geography alone solves the problem. Some people say if America is financially repressed, just move money overseas. That may help in certain ways. International diversification can be valuable. Different countries, currencies, and markets can reduce dependence on one system. But financial repression is not only an American issue. Many developed economies have large debts, aging populations, entitlement pressures, and central banks with similar incentives. Europe has its own version. Parts of Asia have their own version. Global monetary systems are interconnected, so the asset class matters as much as the geography, and often more. Owning a foreign bond that pays less than inflation may not protect you, simply because it is foreign. Owning a high-quality company with global pricing power may protect you better, even if it is domiciled in the United States. This is why serious allocation is not based on slogans. It is based on what cash flows, assets, currencies, and policies you are actually exposed to. Now let us come back to the Federal Reserve structure because it matters in a broader sense. The Federal Reserve System is unusual. It has public responsibilities and private institutional features. Regional Federal Reserve banks have member banks. The system was designed to connect the banking sector with national monetary policy. The details are often misunderstood and often exaggerated, but the important point is that the banking system has structural representation and deep influence within monetary architecture. You do not need to believe in a conspiracy to understand incentives. Large banks, asset owners, and financial institutions tend to be better positioned in monetary regimes that support asset prices, manage crises through liquidity, and reduce debt burdens through inflation. People who own assets benefit from asset inflation. People who only hold wages and cash are exposed to purchasing power erosion. That is the structural divide. The system tends to protect itself and the asset base beneath it. That does not mean every decision is malicious. It means institutions respond to incentives and constraints. When the choice is between allowing a debt crisis to unfold openly and allowing inflation to quietly reduce the real burden, policymakers often choose the quieter path. The person with no assets pays through prices. The person with productive assets may be protected or even enriched. This is why owning assets is not a luxury. It is a form of defense. If you do not own assets, you are mostly exposed to the currency in which you are paid. If that currency loses purchasing power, you must work harder just to stand still. If you own assets that adjust with inflation, you have a better chance of staying ahead. That is the core wealth divide in a repression environment. Not rich versus poor in a moral sense, asset owners versus currency holders. Now, what should a rational person do? First, calculate your real exposure to cash and long-duration nominal claims. How much of your net worth is sitting in checking, savings, CDs, or money market instruments that may not keep up with inflation after taxes? How much is in long-term bonds that could be hurt by negative real rates? How much is in assets with pricing power? How much is in real assets? How much is in diversified productive ownership? Most people do not know. They feel diversified because they have several accounts. But several accounts can all hold the same kind of exposure. A savings account, a CD, and a long-duration bond fund may look different, but all can be vulnerable to purchasing power erosion in different ways. Second, build a purchasing power portfolio, not a nominal comfort portfolio. A nominal comfort portfolio looks stable on the screen. A purchasing power portfolio is built to maintain what your money can buy. Those are not always the same. High-quality equities can be volatile nominally but may protect purchasing power over time. Cash can be stable nominally but lose purchasing power steadily. Gold can be volatile but may hedge monetary distrust. Real estate can be illiquid but may adjust with inflation over long periods. Short-term bonds can provide liquidity but may not grow real wealth. The question is what role each asset plays. Third, avoid trying to time the entire macro cycle perfectly. Financial repression does not arrive as one switch. It can drift in over years. There may be periods of tight monetary policy, periods of easing, inflation scares, recession fears, market rallies, and crashes. If you wait for perfect clarity, you will likely be late. Instead, make measured adjustments. Do not panic. Do not sell everything. Do not buy everything at once. Rebalance gradually toward a structure that is less fragile if real rates stay low or inflation runs higher than expected. Fourth, focus on quality. In inflationary or repressive environments, weak companies do not automatically benefit. Inflation can destroy weak margins. Higher input costs can hurt businesses without pricing power. Debt can become dangerous if refinancing costs rise. Speculative assets can fall if liquidity tightens. Quality matters more, not less. Look for businesses that produce real cash flows, have pricing power, have durable demand, and are not entirely dependent on cheap capital markets to survive. A good inflation hedge is not just something that goes up when people are scared. It is something that can keep producing value when the currency is weaker. Fifth, keep enough liquidity to survive volatility. This is where balance matters. I have said that too much cash can be dangerous in a repression environment, but too little cash can also be dangerous. If markets fall and you have no liquidity, you may be forced to sell good assets at bad prices. A well-built portfolio has enough cash or short-term instruments to avoid forced selling, but not so much that the entire financial future is being quietly taxed by inflation. Liquidity is a tool, do not confuse it with wealth preservation. Sixth, control debt intelligently. Inflation can benefit fixed-rate borrowers because the debt is repaid in cheaper dollars over time. But variable-rate debt, short-term refinancing needs or excessive leverage can destroy you before inflation helps. The government may benefit from repression because it can influence the rules. You cannot, so do not copy the government's balance sheet blindly. If you use debt, understand the rate, maturity, collateral, and cash flow. Fixed low-rate debt tied to productive or essential assets is different from high-interest consumer debt or floating-rate leverage. Seventh, watch taxes. Inflation can create taxable gains that are not real gains. If an asset rises in dollar terms because the dollar lost value, you may owe tax even if your real purchasing power did not increase as much. This is one way inflation becomes even more costly. After-tax real returns are what matter, not nominal returns, not pre-tax returns, after-tax purchasing power. That is the standard. Now there is a psychological piece to this. Most people want certainty. They want someone to tell them the Fed will cut on this date. Inflation will be this number. Gold will hit this price. Stocks will do this. Bonds will do that. The future does not work that way. What you can know is the pressure in the system. The debt creates pressure. Interest payments create pressure. Political constraints create pressure. The central bank's dual role creates pressure. Inflation history creates pressure. Asset owners and savers sit on opposite sides of that pressure. You do not need certainty to act. You need probabilities. If there is a reasonable probability that the next decade includes financial repression, negative real rates, currency debasement, and policy support for asset prices, then holding all wealth in cash and long nominal claims is not prudence. It is exposure. You can protect yourself by owning a diversified mix of assets that have a better chance of preserving purchasing power. That is not a guarantee, nothing is, but it is a better alignment with the incentives of the system. This is the essence of playing the machine rather than being played by it. The machine rewards asset ownership when money is debased. The machine punishes idle cash when real rates are negative. The machine quietly transfers wealth from savers to borrowers. The machine favors those who understand real versus nominal. The machine does not care whether you think this is fair. Fairness is not the operating principle of debt cycles. In debt cycles, the key question is who holds the liability and who holds the asset. If you are only holding the currency, you are exposed to the policy choice of making that currency worth less. If you hold assets financed by long-term fixed-rate liabilities or assets with pricing power or scarce assets, you may be on the better side of the transfer. This is why the same environment can destroy one household and enrich another. The household with cash savings and no assets sees prices rise and purchasing power fall. The household with quality assets sees nominal values rise, rents adjust, business revenues increase, or scarce assets reprice upward. Of course, this does not happen smoothly. There are cycles, crashes, and reversals. But the long-term direction under financial repression is usually unfavorable to people who only save in the currency. This is why I say the greatest risk is not volatility. The greatest risk is slow confiscation through inflation. Volatility is visible. Inflation is less visible. Volatility makes you feel poorer immediately. Inflation makes you poor gradually. Volatility can reverse. Lost purchasing power often does not fully return. That is why people overfear market fluctuations and underfear currency erosion. A good investor fears the right things. Now let us address the idea of a debt cancellation. The government does not need to cancel debt openly to reduce its burden. Open cancellation would be politically and financially explosive. It would undermine trust in government bonds. It would threaten the reserve currency system. It would create legal and market chaos. Financial repression is a quieter form of debt reduction. Keep rates lower than inflation. Encourage or require institutions to hold government debt. Allow nominal GDP to rise. Let inflation reduce the real value of liabilities. Support the financial system when necessary. Avoid explicit default. This is how a large debt burden can be managed without a formal default. It is not painless. The pain is distributed through savers, wage earners, bondholders, and currency holders. That is why the word cancel can mislead people. The debt may not be canceled. It may be diluted. The burden is shifted. And if you do not know where the burden is shifting, you may be the one carrying it. The viral stories may exaggerate the mechanism, but they point toward a real issue. America's debt problem is not going away through normal politics. The Fed and Treasury will be part of the adjustment. Inflation and real rates will matter. Asset allocation will determine who is protected and who is drained. That is the real story. Not one person, not one secret document, not one date. A structural debt cycle. Now, let me be precise about asset classes. High-quality equity should not be confused with speculative stocks. In a repression environment, liquidity can lift many assets for periods, but durable wealth comes from companies that can actually earn money, raise prices, maintain margins, and compound. A company with pricing power can adjust to inflation. A company without pricing power gets squeezed. A company with too much debt may be vulnerable if refinancing costs rise. A company with strong free cash flow has more flexibility. A company selling essential or uniquely valuable products can pass costs through. A company selling discretionary products to stretched consumers may struggle. So do not simply buy the market blindly and assume all stocks are equal. Broad exposure can help, but quality matters. Hard assets should not be confused with guaranteed returns. Gold can sit still for years. Real estate can fall. Silver can be volatile. Commodities can crash. Scarcity does not remove timing risk or valuation risk. But as part of a diversified structure, hard assets can protect against certain monetary outcomes. Cash should not be treated as evil. It is necessary. But it should have a job: emergency reserves, near-term expenses, dry powder. Not an indefinite default position for wealth that needs to survive inflation. Bonds should not be treated as useless. Duration matters. Short-term bonds are different from long-term bonds. Treasury bills are different from 30-year bonds. Inflation-protected securities are different from nominal bonds. Credit bonds are different from government bonds. The details matter. Diversification should not be treated as owning 10 things that all depend on the same outcome. If all your assets only work when rates fall, inflation disappears, and U.S. mega-cap stocks rise, you are not truly diversified. True diversification means different assets can work in different environments. That is the all-weather idea: growth up, inflation down, growth down, inflation up, growth up, inflation up, growth down, inflation down. Different environments reward different assets. A debt-heavy world with financial repression risk requires thinking across environments, not betting everything on the last one. Now, what should you avoid emotionally? Avoid resentment. It is easy to become angry when you realize the system favors asset owners and erodes savers. Anger may be justified, but it is not useful unless it becomes action. Avoid denial. The idea that cash is safe because the number does not move is denial. Avoid overconfidence. The idea that you know exactly when and how the Fed will act is overconfidence. Avoid hero bets. The idea that one asset will solve the whole problem is dangerous. Avoid paralysis. The idea that uncertainty means doing nothing is also a decision, and in an inflationary environment, doing nothing has a cost. The better response is calm adjustment. If you have no exposure to productive assets, begin learning. If you have too much cash, decide how much is truly needed. If you have long-duration bonds, understand what inflation can do to them. If you have no hard assets, consider whether a modest allocation fits. If you are overconcentrated, rebalance. If your spending rises as fast as your assets, control lifestyle inflation. If your financial plan is built in nominal dollars, rebuild it in purchasing power terms. That last point may be the most important. A retirement plan that assumes expenses grow slowly can fail if inflation persists. A savings plan that assumes 4% interest is enough can fail if real inflation is higher. A bond plan that assumes stability can fail if real rates are negative. A cash plan that assumes safety can fail if the currency weakens. A portfolio plan that ignores taxes can fail after inflation creates taxable nominal gains. So build the plan around real outcomes. How much food, energy, housing, healthcare, insurance, travel, and support can your assets buy? That is wealth. Not the number, the things the number controls. When the dollar is strong, people forget this. When the dollar is debased, they remember too late. Now, the argument in the source is aggressive. It says most people will do nothing. That is probably true. Most people do not act on information. They consume it. They feel smart for a moment. They nod. They move on. Their money stays where it was. Their habits stay the same. Their portfolio remains fragile. Information by itself is not protective. Only implemented understanding is protective. If you know cash is being eroded and still hold all wealth in cash, the knowledge did nothing. If you know long-duration bonds are vulnerable and still own them without understanding why, the knowledge did nothing. If you know pricing power matters and still buy weak businesses because they look cheap, the knowledge did nothing. If you know concentration is dangerous and still bet everything on one story, the knowledge did nothing. The system does not reward awareness. It rewards positioning. That does not mean action must be dramatic. In fact, dramatic action is often dangerous. The best action may be boring: rebalance, increase quality, reduce idle cash, shorten duration where appropriate, add real assets, gradually diversify across asset classes, review tax exposure, build liquidity, avoid leverage. Think in purchasing power. Those actions do not sound exciting. They are the kinds of actions that preserve wealth through cycles. One more thing matters. Do not confuse being early with being wrong. If financial repression is a decade-long environment, there may be many periods where the thesis looks temporarily wrong. Cash may outperform for months. Long bonds may rally if recession fears rise. Gold may fall. Stocks may correct. Real estate may struggle. Inflation may cool temporarily. That does not mean the structural pressure disappeared. Debt cycles move in waves. The key is to build a portfolio that can survive the waves, not a portfolio that requires the thesis to work tomorrow morning. If your position is so concentrated that a 6-month reversal breaks you, the problem is not the thesis. The problem is sizing. Good macro thinking must be paired with good risk management. Otherwise, it becomes storytelling. Now let me summarize the structure without turning it into a slogan. America has a very large debt problem. Interest payments are becoming a major burden. Traditional political fixes are insufficient or politically difficult. The Fed and Treasury exist inside that constraint. A likely response over time is to reduce the real value of debt through inflation, negative real rates, and policy that supports debt management. That environment favors borrowers over savers, asset owners over currency holders, and productive or scarce assets over idle cash. It punishes excessive cash, long-duration nominal bonds, and people who measure wealth only in dollars. It does not require a secret plan. It requires only incentives, constraints, and history repeating in a modern form. That is the machine. The machine is not emotional. It does not care who deserves what. It does not stop because savers feel betrayed. It does not explain itself clearly to the people it disadvantages. It simply operates. Your job is not to complain that the machine is unfair. Your job is to understand it and position your life so that it does not grind down your purchasing power while you sleep. That is the hard truth. If you remain only a saver in a system that must inflate away debt, you are vulnerable. If you become an owner of productive and scarce assets, you may be better aligned with how the system resolves its debt burden. That is not a moral endorsement of the system. It is a practical response to it. So measure wealth in purchasing power, own quality, respect scarcity, avoid long nominal traps, do not overhold cash, diversify across asset classes, do not depend on one prediction, do not wait for certainty, do not confuse nominal safety with real safety. And most importantly, stop thinking that the government's debt problem is separate from your financial life. It is not. The debt problem influences interest rates influence asset prices influence retirement accounts, inflation influences wages and expenses. Real rates influence savings, central bank policy influences liquidity, fiscal pressure influences taxes and currency value. You are inside the system whether you pay attention or not. The only choice is whether you will be passive inside it or conscious inside it. A passive person says, I hope my savings will be okay. A conscious person asks, what happens to my purchasing power if this debt is inflated away? A passive person says, bonds are safe. A conscious person asks, safe in nominal terms or real terms? A passive person says, cash is safe. A conscious person asks, safe from volatility or safe from inflation? A passive person says, the Fed will fix it. A conscious person asks, who pays for the fix? That last question is the one that matters. Who pays? In every debt cycle, someone pays. Sometimes taxpayers pay, sometimes bondholders pay, sometimes savers pay, sometimes currency holders pay, sometimes future generations pay, sometimes asset owners are protected. The cost moves, but it does not vanish. Financial repression is a way of making savers and currency holders pay quietly. Once you see that, your behavior must change, not because you are afraid, because you are rational. And rational people do not leave their future exposed to a mechanism they understand. They adapt slowly if necessary, carefully, legally. With diversification, with humility, with a focus on real wealth. That is the lesson. The new Fed chair may matter. Policy personalities matter at the margin. Specific rate decisions matter over shorter periods. But the deeper force is the debt itself and the set of incentives created by that debt. When the debt is small, policy has room. When the debt is huge, policy becomes constrained. Constrained systems behave differently. They search for hidden transfers. They search for ways to reduce burdens without admitting the full cost. They use inflation, regulation, liquidity facilities, and real rate suppression. They protect the system first if you are not positioned. You become part of the adjustment mechanism if you are positioned. You may survive it and possibly benefit from it. That is why this matters now, not later. Not after the official announcement, not after the media explains it in simple terms. By then, asset prices may already reflect much of the shift. Preparation must happen before consensus. The crowd waits for permission. The informed investor studies incentives. The incentives are visible. The debt is visible. The interest burden is visible. The political constraints are visible. The historical playbook is visible. The asset implications are visible. The remaining question is whether you will act on what is visible or wait until it becomes obvious. Obvious information is expensive. Early understanding is valuable, so do not obsess over whether one viral version of the story got every detail right. Ask whether the core mechanism is real. It is large debt, negative real rates, inflation, purchasing, power erosion, asset ownership advantage, cash and long bond risk, diversification need. That is enough to begin thinking differently, and thinking differently is the first step to acting differently. The people who come out ahead in these cycles are not necessarily the smartest. They are the people who understand the direction of the transfer and refuse to stand on the wrong side of it. They do not measure safety by whether the account balance fluctuates. They measure safety by whether their purchasing power survives. They do not worship cash. They use cash. They do not avoid assets because assets are volatile. They own assets because currency is vulnerable. They do not chase every hard asset. They build balanced exposure. They do not believe one person at the Fed controls everything. They understand the system pressures that constrain everyone. That is the mindset. And in a world where the debt burden is this large, mindset becomes money. Because the wrong mindset will sit still while the dollar weakens, the right mindset will build a structure that can live through it. That is how you protect yourself from financial repression. Not by predicting every Fed meeting, by owning the right kinds of assets, avoiding the obvious traps, and measuring the only thing that matters, what your money can actually buy.